Hey everyone, welcome. In this video, I'm going to tell you the truth about mutual funds that banks don't want you to know. My goal is that by the end of this video, you're going to be a more informed investor because you're going to know a little bit more about mutual funds, and we're going to talk about exchange traded funds or ETFs too. So stick around for that. But first, a quick message from InvestoBull, the bull investor. Hey, please like this video by smashing that like button. It really helps our videos and our channels tremendously. It also helps us know what kind of videos you like to watch. Subscribe to our channel if you haven't subscribed already too. Alright, that's it from me. As always, bye. Alright, so let's talk about the truth about mutual funds. If you ever gone to your bank and asked what you should invest in, you've probably heard about mutual funds. Mutual funds are funds of stocks and bonds and other securities that a lot of traditional banks and other financial institutions offer their clients as an investment fund for them to invest in. They can be index funds, so maybe they follow an index like the NASDAQ or the S&P 500 or the TSX, or they can focus on different sectors or industries as well. Traditional banks will offer their clients these mutual funds as investment products, and then they'll take some sort of percentage fee as an annual fee. Mutual funds can be good because they do make it easier for regular investors to invest in a diversified fund straight through their bank. Bank customers don't have to create some sort of separate account elsewhere, so it's definitely an easier route. The thing is, there are tons and tons of other fund options outside of the mutual funds that your bank is trying to sell you. Because don't get it wrong, they are definitely trying to sell you this fund so that they can make their percentage fee. Banks usually like to name their funds with their focus to make it easier for beginner investors to understand. So maybe they'll have funds focused on dividends and income, or funds that are a little bit more aggressive and focused on growth. All good stuff until you start to learn more about the investing world and you start to ask yourself, what am I really invested in? Many investors will invest in mutual funds with their banks without ever really knowing what they're investing in. Sure, your bank told you it's a dividend income focused fund or an aggressive growth focused fund, and maybe even name dropped one or two stocks that are in it. But do you really know everything that's in that fund? Do you know what the top 5 or 10 holdings of stocks are in that fund? Maybe there's bonds in that fund. There might even be other funds within that fund. Many mutual fund investors have invested in these mutual funds without fully knowing what they're invested in. Not good. If you own some mutual funds right now and can't state the top 5 to 10 holdings within that fund, I strongly urge you to dig into it. You may be surprised at what you see, and some questions might pop up. Once you get your head out of the idea that your bank is the best option to invest in, you start to research other options and you start to realize there are tons and tons of other options out there for you to invest in. You also start to realize that your bank may not be the best place to invest all your money in. Definitely not all your money. Looking for alternatives? Start to explore exchange traded funds or ETFs. ETFs are basically other diversified funds that are traded over an exchange like the NASDAQ or the New York Stock Exchange, and you can buy in and out of this ETF just like you would a stock. Your bank may even offer you some ETFs to buy on a separate platform, but definitely be aware of transaction fees and account fees because traditional banks will usually have a lot higher fees. Just looking at BMO here, if you're gonna go investing with BMO on like a self-directed account, you're gonna be looking at $10 per trade for stocks, bonds, and ETFs. And $10 again per trade may not sound like a lot to you, but if you do some research, you're gonna find out that that is expensive. For example, if we look at Questrade self-directed accounts pricing and trading fees, we can see that to buy and trade stocks, it's as low as 1 cent per share, but there is a minimum of $5. So, $5 compared to BMO's $10, so half the price. And it's also free to invest in ETFs. It's free to buy ETFs. You only pay the $5 when you sell ETFs. So this is another huge savings that you're gonna get with another brokerage instead of going with an expensive retail bank. So definitely compare fees. We always want to minimize fees. And again, most banks will charge higher fees than these more modern platforms like Questrade or Wealthsimple, etc. Not only do traditional banks charge higher fees when it comes to investing and trading and opening accounts, but their mutual fund fees are actually higher usually than ETFs as well. Some do have pretty low fees in terms of like 1% or less, but a lot of them are these money market funds, and even 1% is a little bit high, and that's not even the average either. So if you go into, a US equity fund, for example, and it's 1%, I mean, that sounds pretty low. But here is SPY. SPY is also a US equity ETF. It follows the S&P 500, so it's investing in the top 500 US stocks, and SPY has an expense ratio of 0.09%. And we can see here that the average is actually above 1%. There's a lot of funds that are going into the 2% and above. But yeah, I would say the average is about 2%, 2 to 3%. But again, when I look at SPY, their expense ratio is much less than 1%. It's 0.09%. And if I look at other funds too, like for example QQQ, which is a fund that focuses on US tech stocks, they have an expense ratio of 0.2%. One last fund to look at is ARKW. So this is a more aggressive growth tech fund, and they have an expense ratio of 0.8%. So even still less than 1%. It may be a bit overwhelming to research all of the ETFs and funds out there that you can possibly invest in. I know there are a lot of options, but in my opinion, the more options, the better, right? The more options you have, the better chances you have of finding the right product for you. It's like if you're looking for insurance or a mortgage, you could go directly to the insurance provider or your bank and look at their options, or you could work with a broker who would provide you with a bunch of other options, all of the options, and then you pick the best one for you. That's kind of the case here. The banks are only going to give you their funds, the funds that they're going to make money off of, and they don't want you to really consider any other options. So it's up to you to research and do your due diligence in finding the funds that you want to invest in, minimizing your fees, and educating yourself as much as possible, which is the first tip in my video on my top 5 investing strategies and tips for beginners. Definitely check out that video if you haven't already. But that's what I wanted to talk about in this video. I hope you learned a little bit more about mutual funds. I hope I provided some value to you, or at least piqued your interest a little bit. If you want to learn a little bit more about ETFs and tech ETFs, definitely check out my video on investing in tech ETFs, where we analyze QQQ and ARKW, 2 tech ETFs. Anyways, I hope you liked this video. If you did, smash that like button. It really helps the video and the channel. When you like videos, it also helps me know what kind of videos you like to watch. Please subscribe to my YouTube channel and sign up for notifications if you haven't already. Let me know in the comment sections if you have any questions or feedback or experience with mutual funds and ETFs of your own. All right, I'm gonna wrap this one up, so I will wish you a good day, a good night, and I will see you next time. Until then, cheers.
Check the mic and make sure it sound right, boys.